Good afternoon, everybody, and thank you for joining us for our presentation this afternoon, Recurring Revenue Ripples Through Revenue Recognition. Here at SOFTRAX, we're happy to be joined by the professionals over at Aria Systems, and we should have an excellent presentation for you this afternoon. As a couple of people are still filtering into the room, I'll just go ahead and I'll go through a few housekeeping items for our presentation today. This will be a CPE eligible event, a CPE eligible group internet-based course, 1.0 credit in the field of accounting. So in order to be eligible for that CPE credit, please make sure that if you are interested, you answer all 4 of the polling questions throughout today's presentation, as well as the post-webinar survey. Those are very helpful for us in general, and we'll be able to distribute CPE certificates via email after the webcast conclusion. No further action required on your part. And then as far as participation goes, at any point, please feel free to submit questions through the Q&A feature on your GoToWebinar console. There will be some time for questions and answers at the end, and it's very important to us that we do give you a chance to ask any questions, and we will answer all questions. If we run out of time, we'll reach out afterwards and provide those answers. So it's my pleasure to introduce to you our speakers this afternoon. Our featured speaker on the SOFTRAX side is Tom Zolli. He's our SVP and General Manager, and he has a long track record of helping companies with advanced revenue recognition and back office automation in general. He has a long career, and he's a thought leader in the space. We're excited to hear from him on this topic, and we're excited to be joined by our guest speaker from Aria Systems, Michael Carrell. Aria Systems billing and monetization platform enables its enterprises around the globe to monetize their products and services and to more effectively serve the customers. And Michael has a lot of very interesting insights on this topic today. We're very excited to be joined by him, and it should be an excellent panel for you. So without any further ado, what I'll do is I'll go ahead and I'll launch our first polling question of the afternoon. And I'll also give Tom and Michael a chance to sound off on it. So the first polling question is very simply, have your companies started moving to subscription or usage-based billing models? And you can see a few options down below. I'll launch this and you'll be able to answer in the console. So Michael, Tom, any thoughts?
Yeah, this is Mike Carrell, and hey, it's great to be with you all today. And Tom, thank you for having me. Ian, thank you. I think the reason why we wanted to pose this question as a poll was to take a temperature of where people are in their journey from moving from a one-time purchase toward subscriptions and usage-based business models. We can see here some we see some responses coming in where people they're using it, or well, they're planning to do this, or maybe they don't have any plans. So we'll talk about maybe why you want to consider this and some of the benefits and the impacts that what ends up happening is when it affects revenue recognition.
Yeah, and thank you, Michael. Thank you, Ian. It's good to join you guys for this webinar. One thing that'll be interesting to see on the poll is if there's been an acceleration to subscriptions due to COVID, because I know that, a lot of people felt that were in recurring revenue models felt like they were a bit safer during COVID than those that were selling sort of a hard goods and one-time sale price. So it'll be interesting to see.
Yeah, how many streaming services did you subscribe to, Tom, during this whole 2020?
Yeah, too many, too many.
Great, thank you guys. I'll go ahead, and looks like we have a lot of large proportion of the responses in. So if you're still thinking, please just go ahead and submit your response, and then I'll go ahead and close the poll and share the results. All right, and we do have the breakdown over here. Looks like there is one, pretty clear majority.
Yeah, I would say, Michael, I don't know your perspective, but from the past surveys we've done, I'm not as much surprised to see more people moving to subscriptions, but it's great to see a lot of people moving to also usage-based models.
Yeah, that's good to see, and thank you everyone for providing your input on this. I think we've got some things to talk about here that are going to go right down the middle lane of what you're interested in.
Excellent. So thank you all. And with that, I'm happy to turn it over to Michael to continue the presentation.
Thanks. Appreciate that, Ian. So there are a couple of themes that I wanted to put forward today. The shift in business models, and complementary to that is the need for agility. And these combine to impact how you engage your customers, how your revenue operations takes place across billing and monetization and revenue recognition. So let's take a look at that first concept of the shift in business models. Go to the next slide. Thanks. So here, this is a world that many are familiar with. It looks like most of you are familiar with a further evolution of this, but when you go from a fixed price item, it's a physical item, perhaps it's got a product, it's got a price, it's kind of one-dimensional. And when we see that shift from ownership to access when things move into a subscription. So then it becomes a product, a price, and then there's a time frequency at which things are being renewed, bills are being paid, revenues being recognized. So you could see a shift from, let's say, owning a DVD to subscribing to a Netflix service streaming, or owning, or quotes in the air, a packaged piece of software to accessing it in the cloud. And then it moves toward a hybrid with more dimensions where there's subscription and usage, and there's of course the dimension of the time, the frequency, the product, and the price. One of the things that most people are familiar with, of course, is their own cell phone plan, where there may be a baseline subscription, the access of 4 lines for $80 a month, but then $25 for the gigabytes of data per month. But over that, you pay overage fees. And that's a personal or consumer example. And the business example would be Amazon Web Services, where you pay as you go for the usage-based elastic compute cloud services, almost paying per second. So the unit of time the unit of thing that's being measured is very different there. And then the next step in the move in dimensions is really multi-dimensional, where there's the product, the price, the frequency, the usage, and who is using the service, who's using it, who's paying for it. Could be different. It could be a fleet of vehicles where one headquarters is paying for all the fleet in the county or the state, or it could be a parent paying for a child's set of subscription services, but not the HBO. You got to pay for that yourself, Tom. So it could be. And this is happening, this move to the multidimensionality is happening across all industries as well, not just my examples here of video or telecom, but like technology, of course, but in construction, in auto insurance, in vehicle services, fleet management, healthcare, it's across really all industry spectrums. And I'll get into why that may be happening and the benefits of both of these dimensions. So you can go to the next. So a subscription itself has an advantage of you're creating an ongoing customer relationship and you're building a recurring revenue stream that is good for your company. In fact, throughout the last year, a lot of companies that did really well had a recurring revenue stream. But when you add in a usage-based business model, you see that it actually can expand the market that you can address, because there may be some buyers who weren't willing to plunk down a certain amount of money right up front and pay for a subscription for so many users to have access to a SaaS software, for example, but they may want to have usage-based over time and have it grow as their use grows. And you also, usage models are great because you basically are baking in a built-in growth path of expansion, because clients can start small, they can grow, and then on a sort of a product measurement and technology and measuring your customer success, you can measure the customer activity, and you can also communicate dynamically with your customers and set their correct expectations. So bottom line, it also makes customers happy because they get what they pay for what they get. They're only paying for what they use. And in especially some tight economic times that we've been going through and are hopefully coming out of, is that's been important to consumers, but also to businesses as well. There was a recent study that was done by IDC that reinforces also how usage-based business models can help with renewals. And renewals are essential, of course, for a recurring revenue business. That's what keeps that revenue coming in, is your customers staying with you. And a subscription model may be somewhat susceptible, but I think what they're finding here in this survey responses is that the aspects of a usage-based business model is supporting the renewal because you're getting a value for the price that you pay, and that it eases the renewal process. Basically, you stay connected and you bill for usage, and that the number of licenses or users, you don't have to worry about how many people you're adding. You basically activate as many users as you want, and you're charging for the usage. So I think this was an interesting piece of research to see. And in that same research on the next slide, they also found that 42.4% of the companies that they surveyed were actually planning to offer consumption-based or usage-based services in the next 2 years. But there was an additional interesting thing, that some of those that were already offering it found that they had some solutions in place that weren't quite meeting their needs. And I think that could incorporate people doing manual methods, Excel, or maybe they started off their journey on subscription, but they went with a solution stack that wasn't quite up to the task of handling this complexity, this multidimensionality that I was mentioning earlier. Let's go to one final point here to talk about the move from the one-time to subscription and usage-based. This is what some of the business models look like over time or across units consumed. And just wanted you to get a glimpse of what these look like. And these variety of monetization models, they give your company the ability to experiment and iterate and tailor the pricing and packaging to meet the needs of your market. And that brings in the second point that I'll talk about later, is the agility. But one of the things to look at here in the upper right-hand corner is volume pricing. That is a usage-based business model where those little blue horizontal lines, as the usage crosses over that, then the price per unit is set to be different, so that you're rewarding their ever increasing consumption with a lowered price, but they don't get that until they cross that threshold, and that applies backward to all of the units that they've done. So perhaps a service credit is issued. That probably has an effect on variable consideration calculations, I'm guessing. And then we'll have a look at, on the top row, the second from the left, the freemium. That's where you're not paying anything for a period of time, but then you get to a point in time where you are paying, but you're using the service. And I'm imagining that has an effect on revenue recognition downstream. So I'll hand it over to Tom to talk about some of these business models, usage-based and subscriptions, and their effects.
Oh, perfect. Thank you, Michael. Thank you. Yeah, so I'm going to talk a little bit about the downstream ripple effect of these of all of these wonderful business models, and really specifically talking about the impact to revenue recognition. So Ian, if you want to advance the slide, then you can go to the perfect storm slide. Next one, yeah. So I realize that there are some people on the line that aren't accountants per se. So as the accountants are aware, one of the interesting things that's happening right now is that you have sort of this convergence of events. One of the big events that's occurred in the last few years is this migration of effectively the world to a single accounting standard under ASC 606 and IFRS 15. And it's a big thing. I mean, it brings the world to one standard. It replaced well over 100 pieces of guidance in the United States. It's occurring, right as at least I feel that companies are accelerating migration toward subscription and usage-based billing models. And interestingly, some of the most complex portions of the guidance could be triggered by these billing models. And literally, it gets to a point where if you make a slight change to a business model, or slight change even to the contracts, you could take your revenue recognition from something that's actually very simple to something that becomes now extremely complex. And we'll talk about some of the examples as we go through this. One of the biggest examples, one of the biggest facets of ASC 606, I would say, is just the whole notion of separating the order to cash and the order to revenue recognition processes. And that separation basically means that, unlike in the past, where revenue recognition would typically be triggered off of a billing event, it's no longer the case. And it's a problem for companies because a lot of the ERP systems that have been built over the last decades are designed specifically to trigger rev rec off the billing event. Now you have a situation under 606 where they say, no, billing and revenue recognition should be separate schedules. You can recognize revenue ahead of the billing event, but they add disclosure requirements. So you're reporting to the public markets via, these contract asset and liability disclosures. If you've recognized revenue ahead of billing, how much have you recognized? And likewise, if you billed for a bunch of services that you haven't performed yet, you have to disclose that as well. So it adds some complication. Some of the things that we'll talk about in the coming slides are things around the allocation portion of the guidance, the need to do and to handle contract modifications. It's called contract modifications and combinations in the guidance, but it's effectively detailing how you handle changes to contracts while they're in flight. Michael mentioned variable consideration. We'll speak to that. And there are many other portions of the guidance. We obviously can't cover them all today, but things like material rights, the significant financing component, etc. So let's dive in, and we'll start off talking a little bit about variable consideration. So interestingly, consumption-based billing or usage-based billing in particular can be a trigger to variable consideration. And certainly, consumption-based billing has been around for quite some time. I mean, paying for electricity by the watt hour, paying for water by the gallon, etc. In the case of the new guidance, when you are billing in this manner, if you have a contract, it's actually, fortunately, the guidance is laid out, excuse me, very cleanly in terms of paragraph numbering. So it's actually paragraph 606, 1032, 5. But effectively, it's saying if there's a portion of the contract that includes a potential variable amount, that you have to account for that and account for it in the consideration of the contract. And really, there's two ways of doing it. There's something called an expected value approach and also a most likely amount approach. So the most likely amount approach we won't speak too much here. It's more applicable, for example, if you're running maybe you're running a service which says that if I complete a project within 10 days ahead of the deadline, I get a bonus. And it's a very binary thing. It is variable consideration because you either get the you either get the bonus or you don't, so the overall contract value could change. But we're going to focus on the expected value approach. And the expected value approach would be more applicable to something where, like, I have a subscription. Your cell phone bill would be an example. You get so many minutes a month, but if you go over, there's an overage fee. And so really, if the cell phone bill were $50 a month and it's an annual plan, the total value of that contract would be $600 plus that variable component. And what is the variable component? Well, typically there would be some sort of an analysis that would say, well, how often do people go over and how much over do they go? And you would perform that analysis and then factor that component in to the revenue recognition. And keep in mind, this has to be done on a contract by contract basis. So the repercussions in terms of trying to operationalize all of this can grow quickly. In the next slide, we're going to talk about an example. And, this example is triggered by the fact that the guidance says that you have to basically use all available information in as part of your assessment of variable consideration. So in this case, it's just a public company, X, they sell a subscription, and, month to month, if usage goes over a given amount, let's call it a minimum, it yields overage fees, similar to that cell phone plan. So this would be considered variable consideration, and you would use the expected value approach to determine it. The interesting thing is that because you're required to use all available information in terms of determining the amount of variable consideration, we've seen a number of examples out there where the auditors have prescribed effectively that you need to look at the amount of overage on the contract for the prior periods in the contract. And, at surface, it sounds like a very reasonable thing. But again, from an operational perspective, it gets very difficult, because what you're basically saying is that month to month, so when I start the contract, I would do my assessment and say, okay, as an example, people go over by 10% of this customer type. They go over by 10%. So I will include in the total consideration that amount of variable consideration. As you go through the periods, month 1, month 2, you're now recognizing not only the minimum that is already in the system, but potentially overages. If there are overages, those would be reported by some upstream system reporting actuals, and you would be recognizing those overages month to month. The guidance stipulates that you have to revalue the variable consideration at your reporting periods. So for a public company, quarterly; for a private company, annually. So each quarter, you would recognize the actuals month to month for the 3 months. At the end of that quarter, you actually have to use the amount of overage that occurred in the prior months, and in that case, in the first quarter, and refine your estimate of variable consideration for the coming quarters 2, 3, and 4. So you can imagine things start to get very complicated very quickly. From an operational perspective, it's likely the upstream system is only sending you the overall usage, right? So you have a minimum that you're recognizing. It's sending you the overall. You have to convert the actual usage that occurred, understand what the minimum was, which could be specific to that contract potentially, understand then what the overage was, recognize that as well, and then maintain that in terms of the next estimate of variable consideration. So it's an example where RevRec gets very complicated very quickly. And we can go to the next slide.
Well, Tom, I can chime in about this this other concept. I mentioned that there were a couple of themes I wanted to put forward with the shift in business models, but the need for agility and the flexibility of those business models. Sorry about all the trouble it creates downstream, but it brings your company agility with your customers. And there might even be a subcategorization of this of like ordinary agility and extraordinary circumstances or extraordinary agility. And I wanted to get into both of those. So let's go to the next slide and I'll show you what I mean. So with a one-time purchase, an object or a service is purchased and either an invoice is generated and then paid with a credit card or a check, or maybe right there at the checkout stand, or an online purchase of a physical item. The credit card is hit right away. It's pretty straightforward. Maybe you're buying a pair of jeans in a store or curbside, or maybe you're buying something online. But the direction that things are moving with the addition of usage-based and combining that with subscriptions and the sophisticated model, if you click to the next, this actually becomes a whole field of stars of these moments that happen. So after someone is signed up for that service or purchased that service, then maybe simultaneously a welcome email is sent, and also a provisioning is happening where the service is being switched on. And then as they're using it, if we look partway up that field of stars, maybe they're using at a fairly rapid rate, almost at a rate to consume 90% of their plan before they're not even halfway through the month. And so you can trigger, you can observe these moments, and you could trigger an offer that goes to this particular user and says, hey, I notice you're using quite a bit and you signed up for the silver plan. Maybe you want to upgrade to the gold plan, and we'll give you a 10% off your first 2 months if you do that. If you sign up right now, and it'll save you from hitting overage fees. Here you go. And also on the other side of things, when perhaps payment isn't made on time, or when a change is made there, then we can follow up with, hey, please pay your bill, and some dunning that occurs then. But really what happens is a lot of things like an upgrade mid-cycle, where they take advantage of that offer you gave them, or maybe they add more users into the plan. all of those little moments can happen in between when a bill would normally go out and when a payment would normally happen. Those can be asynchronous. It could happen at 2 in the morning that you add a bunch of new, you upgrade from your basic streaming plan to your plus. And that's outside of your rhythmic and synchronous, let's say monthly or quarterly payments that happen. And so that can create a ripple effect. It may get other departments involved. You've got solution where you've got a system here where basically people are engaged or machine-to-machine communication is taking place, and there can be changes that happen to the, let's say, the contract. And the contract could be a physical contract that was signed when a person sat down with a sales representative in a B2B sales sense, or it could be when a quotes in the air contract is put in place by clicking on downloading and clicking agree, and putting plan X into play, and then that's got baked into the revenue recognition and the billing that are normally handling that on a regular scheduled basis. So how you react to these scenarios and these synchronous and asynchronous events really can have an impact on the customer experience. Are you observing? Are you paying attention? Are you being thoughtful and engaging and offering them things? And that will affect the overall lifetime value that customer, whether it's a business or an individual, that they'll bring into your company and the total revenue that they bring in. So it's worthwhile to have that agility to be able to pay attention to that and engage your customers. Did I create any problems for you, Tom?
Excellent. Yeah, I was just going to say, I feel like I'm a bit schizophrenic in a way, because I see that slide and think about, part of me thinks about all of the wonderful things that can be done, and we certainly try to employ those methods. So from a business perspective, it's all great stuff, and I think it really helps the customer relationship. And then on the other side of me that thinks about the downstream accounting, it just sort of gets horrified. But we'll talk a little bit about that next. So we're going to jump into another slide, and this is another example of a ripple effect from some of the things that Michael talked about. And this one, I wanted to speak a little bit about the impact of change and flexibility on revenue recognition. And I'm going to focus in a little bit on the called the contract modification guidance, and it's basically the portion of the guidance that deals with, what do you do if you have a contract that's in flight with a client and you're making some change. And so 606-1025-10 defines what you have to do. Now, I want to take a little bit of a step back. So one of the big things that came out of the new guidance wasn't necessarily net new, because we did have it under 605, but it's this concept of doing what are called proportional allocations. And so, the situation that I feel gets very complex is if you're a company that sells not just a single thing, what would be called a single performance obligation in accounting parlance, but it's effectively, for now, let's just say a single line item. And now you move to selling multiple line items. So it would be called a multi-element arrangement. And if you have that situation and you discount or at least discount significantly, then you would fall under this allocation guidance. And the guidance, is put in for good reasons. It basically just says that if you have that situation, you have a responsibility to keep track of what you sell each of those line items for when they're sold standalone. It's called a standalone selling price. And then going forward, as a net new order comes in, order by order, contract by contract, you would assess the total value of that order, and you would redistribute that value proportionally among the line items according to those standalone selling prices that you maintained. So it's effectively moving money amongst the line items done for each contract, and that was made core to 606. It existed under 605. People in the software vertical would know it as VSOE under 97.2. So it did exist in some of the industry-specific guidance. The problem that I think arises is, if you are a company that has multiple line items and does discount, and you notice here, I kind of put the worst case scenario here, because what I'm saying is, I'm a huge fan of offering self-service portals to clients, because I think it's great to allow them to, have the flexibility to up select or down select functionality and other attributes. However, it can lead to this sort of, scared chicken moment where it can be a tremendous burden on the accounting department. And the reason for this is that not only does that allocation process potentially have to happen as each new original contract comes in, but every time they make a change to that contract, it could trigger 606 102510. So it could trigger this proportional reallocation. And basically what you're doing is you're assessing things to say, okay, first of all, the new thing that I'm selling, am I selling it at a discount, basically? And if you are, then, and there's this concept of distinct obligations. So these are basically have standalone value. Then you actually end up, from a revenue recognition perspective, you end up considering it a termination of the original contract. You take all of the dollars that are remaining on that original contract, sitting in deferred, and you add those to this new contract with the new items, and do another, what's called a prospective allocation. So you're going through that allocation process again against standalone selling price, and it gets more complex from there, because there are issues. Standalone selling price, for example, is often specified against like a unit quantity, a unit time. So you have to bookkeep, how much time is left on the contract, therefore calculate what the effective standalone selling price is. Same deal on the quantity side. So it gets very, very crazy. And this is all talking about modifications that would occur given all the performance obligations are distinct, meaning that they each have standalone value. There's a whole other set of the modification guidance that deals with non-distinct obligations and what you have to do there. And I don't think you would see that in the SaaS world so much. You would see non-distinct obligations in the manufacturing world, or large construction, or the classic example would be, you're building a machine, it's halfway done, the machine doesn't really have value other than scrap value maybe at this point. They request a change to get to the ultimate system that they want. There's other processing. You'd have to recognize that this is, okay, now a non-distinct contract modification, and perform other processing to do usually what's called a cumulative catch-up, and adjust the amount of revenue recognized against now the total scope of getting to the end state of the new machine. In a few cases, we've seen where companies have both. So they could be selling SaaS, but they also could be selling some non-distinct obligations and have to deal with both. So you start to see, it's difficult enough to talk about it, but imagine a system's receiving these inputs and needs to have a way to understand, are these obligations distinct or non-distinct? If they're distinct, were they sold at a discount or not? If they were sold at a discount, I have to trigger a modification, but I have to go through some pretty complex calculations to determine the SSPs that I have to allocate against, and it goes on, from there. So we'll talk about an example quickly of one case, and then we'll move on. So in this case, I thought it was an interesting example. So it's just a SaaS company. They have a SaaS offering. They bundle it with services and training to get the product launched, people up to speed. But they do provide a self-service portal so that a client can, at their leisure, increment or decrement functionality. And to just make it a little bit more complicated, and I don't think it's an uncommon scenario, but from time to time the company will, offer discounts to entice companies ideally to increment functionality. So this is a classic case where I do think the revenue recognition could get very complicated very quickly. You start to see these ripple effects, because the items are sold at a discount. It's definitely going to trigger 606 102510. And like I was describing before, I mean, for each time they make this selection, potentially, depending on the language in the contract, obviously, but it could trigger, the need to consider termination of the original contract, do the prospective allocation, and everything I described in the previous section. So it interestingly is an example where you can change your business process very slightly, actually, and even down to language in a contract, your standard contract very slightly, that trips you into a situation like this. And when that happens, I think it could take RevRec from something that's relatively basic to something that now is getting exponentially more complex. So something to be aware of.
Well, Tom, that's maybe what happens in an ordinary business scenario for company Y, as you mentioned in your example. What we were seeing, and I mentioned earlier, ordinary agility. I think the revenue moments that happened there and the ripple effect. But we saw another really large market force in 2020, which kind of continues into 2021, and it exposed the need for extraordinary agility. And actually, it may not only have been the customers asking for things, it may have been the companies themselves wanting to pivot and change what they were offering and sell them in new ways. And many companies had, if they already had a digital transformation underway, they accelerated it. If they didn't, they may have launched a digital transformation to move more and more of their sales online, or to offer a subscription or offer a usage-based service. We were seeing some companies in various industries, except for a few that were hit pretty hard. Many large enterprises thrived because they had some agility and because they were offering their products or services as recurring revenue basis, and they were able to adjust. There are some good examples where businesses would come, or the end consumer would come to the company, and they were seeing some cash flow issues, and they would reach out and ask for relief. Or maybe companies were seeking to proactively provide relief to their customers, and basically to support the brand and retain them. And that some companies were also facing, they were seeing that their client base was scratching their heads and thinking about, well, is now the time to make a big purchase? Well, these companies would turn and offer a ramp of an easier way to get in with a lower cost commitment. So there are some examples here from the news where Microsoft made, of course, Teams was available to people for free, individuals for free for chatting and stuff, but they also made it available to corporations, companies to install, and IT professionals could go with a free trial, or even HubSpot. Businesses were selling to consumers. They wanted to give some flexibility and also enhance their brand, so they were offering, like Allstate were giving a discount, baked in discount to the auto premiums, and they were providing a free identity theft coverage as people were spending more time shopping online and purchasing products and services from home and not going out. They felt more secure in having their identity protected with the identity theft protection. And Subaru is another good example of how they offered relief for finance purchases. They were offering more time to pay, and they were offering deferred payments for new purchases. So this sort of agility was not uncommon to see in the news, and some of these are actually Aria customers, by the way. But I think what we want to find out from our audience in the poll is, what sort of financial gymnastics were clients asking of you during 2020? What were they asking of your business? For example, pausing the service, or deferring payments, or asking for service credits, or a free trial period.
Yeah.
Sorry, I stepped on your lines there, Ian.
There's probably many others that we could have put on this slide, right? There's so many things that, people were asking for, legitimately through that process. But well, it's interesting to see what the most common ones were from the survey.
And just to be clear, this is a multiple choice, so it's going to be a multiple checkbox. So if there are multiple, feel free to vote for multiple, whichever ones apply. Because we are in danger of running a little long, I'll just close this one up pretty quickly. So Please, if you are still thinking about it, just go ahead and vote, and then we'll just take a look at the results pretty briefly. All right, and just another second or two and I'll close and share.
Looks like there's a clear leader there, 73% respondents on the deferring payments or changing terms of payments. But even representation down in the 15, 19, 19, 15 space, and pausing coming in a close second there. Well, let's take a look at some of the scenarios that Aria Systems saw and helped our clients with. These are like real life examples. I'll step through and maybe pick up the pace just a little bit here of what I'm talking about so that I don't squinch Tom for too much time. But an example of a, as you can imagine, let's call them Studio Cloud, that they offer a platform, and in-person fitness studios and wellness services were using the platform, and the end customers were all of a sudden sheltering at home, so they couldn't attend in-person classes. So rather than cancel the entire membership and entire subscription, Studio Cloud wanted to be able to enable their studio companies that were offering these services to in turn offer to their customers a pause of the subscription. So let's go to the next. What does that look like? So ordinarily the digital, let's say digital and in-person classes were offered ordinarily, and across time there would be invoices generated, payment happening all across time. But then the modified plan, if you click one more build out, the digital would continue the access to digital classes, but pausing of the in-person classes. So then the amount that is being invoiced, the amounts being paid is adjusted over a period of time. And then at some point in time, it would unpause and things would move forward. So that was one scenario that we saw in real life in business. And that was the agility that they were looking for in their technology, their revenue operations stack. And then another company that we'll call Customer Desk was they wanted to keep their existing customers paying now and reward them in the future for sticking with us. They were seeing that their clients were pivoting from having a room full of their customers typically would have a room full of people, shoulder to shoulder, answering telephones, maybe on a help desk, maybe on a call center, maybe fielding calls for booking travel or customer support. And that shifted from different sometimes their customers changed and everyone had to work from home, or sometimes the number of people that were covering different things changed. So they really needed agility to turn around and offer their clients who use the customer desk to have the agility to do what they needed to do in the business sense. So let's go to the next slide and see what that would have looked like. The original plan, they're paying along for the one or more services, but then they wanted to be able to offer a service credit and then automatically draw down that service credit, apply that service credit later to services consumed, let's say in the October, November timeframe, so that they weren't literally giving away cash or money. They wanted to do it this way, the service credits. And that's one of the advantages of a usage-based business model, where you could give a pile of units of things and then have a person burn through that in the future. Let's go to the third example. So we'll call this company FICOGuard, where they had a few prospects that were business clients. Now they may have sold their services to individual consumers, but there were business clients who were looking to buy the credit monitoring services to look into their customers as they sign deals with them. But they weren't sure they wanted to commit signing a big deal with FICOGuard during what was sort of uncertain financial times for them. So they weren't sure. FICOGuard wanted to be able to put them over the top. So they said, well, let's offer that a trial period, but let's make it a little more sophisticated and put a ramp in. So let me show you on the next slide here. So rather than asking for a amount payment to be upfront, they said, well, let's have them sign up and give me a couple clicks here. So they may sign up initially and have a free trial period, and then they go to a stair step up in price. That's an introductory price, and then one more step then they'd be at a regular price. So how can they do this in mass so that their salespeople are operating effectively, and that when the time is to move from the free into the intro into the regular price, so that that happens automatically, and that the ball isn't dropped as this customer transitions through these phases. So the automation was also what they were looking for, in addition to the agility. And I guess automation was important as well across all of those cases I mentioned: the free trial, the service credits, and the ramped offer, because we want to be able to handle these things automatically. So I guess we wanted to poll you and find out, how automated is your revenue operations technology stack?
Yeah, it'll be interesting to see, given the amount of usage. And I was thinking about it, Michael. I mean, so the usage percentage was much higher than previous surveys, although the subject matter of this one, lends itself to having people that are wrestling with these issues beyond anyway. So that could be why that percentage was so high. But given that usage, that amount of usage, I'm suspicious that it's going to be more in automation than we've seen in prior surveys potentially. So.
One would hope. I think we've seen, as I mentioned way early on, that IDC was seeing that people were selling usage-based services, but they weren't necessarily happy with the mechanism by which they measured, collected, and measured and billed for and collected for the usage services, and they were planning on upgrading. They might be doing it with Excel. They might be doing it with Steve running around in circles with a clipboard. You never know.
Great. So I'll go ahead and close this one as well. So if you're still thinking, please go ahead and make your submission. All right. And for results, we have another pretty clear winner, it looks like.
So that supports your point, Michael. Yeah, even with usage, I mean, it speaks to how complicated getting to, it's 80-20 rule, right? Some automation, easy. Full automation, not so easy.
Yeah, it's hard to get to the perfect automation, perhaps, but yeah, I think anywhere we can help, it will help not only the billing and monetization, but it'll help automate the revenue recognition downstream. So.
Sure. All right. With that, so I'll just speak briefly on the scenarios that Michael represented in terms of ripple effects on RevRec, and then we'll move on to the next section. So, there were 3 different cases, and all interesting because all had impacts on recognition. I think in the Studio Cloud case, it's a bit more self-contained in the sense that it really represents the need to pause revenue recognition, and then literally just pause it for the periods that the service is paused. The customer desk one was interesting to me because it has this concept of including effectively a future discount in today's contract, which I won't go into detail here because we're running out of time, but if you have something like this, what I would encourage you to do is look up the material right portion of the 606 guidance, because there's probably a material right in that contract, and it has to be dealt with in a particular way. And the FICO Guard one was interesting too, in the sense that this really, it really brings clear the separation between order to cash and order to revenue recognition, because in the one case, you have billing that's effectively escalating up over the term of the contract, but from a revenue recognition perspective, and again, a function of how the contract's worded, it's very likely that you start recognizing revenue right out of the gate and recognize it, consistently, ratably. What accountants refer to it as ratably, but the same amount period to period, because the delivery of value is the same period to period regardless of the billing. So speaks to that need to separate order to cash and order to revenue. And so, Ian, if you could go to the next slide. So, I mean, just to sum up, we talked about a number of circumstances that could exist from a billing perspective. Michael spoke to those, and the benefits to the business. And I think there's certainly there, and I think people agree that usage-based billing and generating a relationship with a customer over time via subscription billing is all good. We spoke to some of the impacts that could occur. We spent a lot of time on the first two, variable consideration and also contract modifications. We didn't talk about combinations. It's a somewhat separate topic, but there are others. So there's issues in the new guidance around significant financing, material rights we spoke about briefly. There's a number of issues around contingencies and usage. And so, given all of that, what I wanted to do next is speak to how this can be automated, how you can take it from, as was provided by the survey, so, and what we see a lot is, yes, we're automating some parts of it, but difficult to automate all of it. And I will say from the SOFTRAX perspective, we really appreciated the partnership with Aria, and I think our combined clients have really appreciated the partnership because it offers some things that are not easy to achieve. And so this diagram gives you a very high level look at the architecture, but basically, what we're providing as a sort of partnered solution is, first, there's a lot of depth of functionality in each of the products. It becomes important because we're able to basically eliminate the need to customize, to push stuff to spreadsheets, all the things that companies are typically trying to avoid. If you notice in the architecture as well, it's really set up well for this separation of order to cash and order to revenue recognition. Now you do see, so in a typical implementation, source data, order data, etc., will come from upstream systems and go to both of us, but you do see the bill data moving from Aria to SOFTRAX, and that really is specific to that need to manage the state of revenue, that contract asset and liability balance that I mentioned. And then journal entries obviously going to the general ledger. One of the things that you see in the architecture, and I think this is probably very important as relates to some of the topics we've discussed, we both apply a workflow engine, and in fact, it's the same workflow engine. And I mentioned earlier in the presentation that for things like modifications, variable considerations, one of the challenges in automation is that a decision process has to occur when a transaction arrives, whether it be a new transaction or a change event, and that decision process really has to have an understanding or be fed an understanding of prior events, current state and prior events. So for example, in the variable consideration case, when it has to be revalued, it needs to understand, what were the overages experienced to date in that example. In the contract modification situation, if a new order comes in and there's a change, it needs to understand, was there a prior order? Are the obligations distinct, etc. The workflow component provides a lot of power to these solutions in the sense that transactions can arrive to workflow. We can actually embed some of the decision process in workflow and have it reach into the database of the application to understand state and guide the decision process. And then it makes the appropriate calls into the application to actually carry out the execution of it. So, the key thing for me is really there is complexity in these models. It is hard to automate. It is hard to get to that last 20%, but it is not impossible. It can be solved, and I think the combined architecture is sort of uniquely positioned to do that. And with that, I think we go to the.
Yeah, there's one other thing I would add to you don't have to go back a slide, but that was a real customer example that you were talking about, where we're both Aria and SOFTRAX were in play, and the workflow, yes, it does help get that last 10-20% of the business process that needs to be put into play. I think one of the things I would add is that the large part of what you do with Aria and why finance teams like Aria is because it's not customized, it's not coded with like someone sitting down and coding something, but it's configured where you can select all of those types of plans that I mentioned earlier. You could say, I want a usage-based plan, here's the rate. You're basically clicking and filling in fields and then clicking save. You're not having to get an IT resource to come and program something. Plus, the system is built for enterprise. It's large scale, cloud agnostic, industry agnostic. It's very open. When we go into engagement, Aria goes in, and we know that we're going to integrate with systems like SOFTRAX and other things up and down the line, because we're best of breed. We're very deep and very focused on billing. And I think, but back to the point about configuring, is that that enables a lot of Aria's clients to have, rather than someone who's internally has programmed a billing solution and they're locked in, it allows you to have a team of people who are able to configure what's going on and understand what's going on, and they like that factor. So I wanted to mention that. I think we should go to the final poll. Yeah, okay.
Great. And thank you again, Mike and Tom, for your insight on this. I'll just go ahead and launch our final poll, and thanks to our audience for sticking around. If you're in finance, how much support do you rely on from your IT department, based on what Michael was just saying?
Yeah, I think that's something that I've gotten consistent feedback on from the current users of the applications, is that the ability to, like you said, Michael, configure versus customize, and we hear it on our side as well. People talk about vendor version lock-in and wanting to avoid that, and I think you could tie that directly back to avoidance of customizations, essentially.
Yeah, exactly. And that allows you to be more agile, move at a quicker pace, introduce new offers, and make sure they're correctly recognized.
Great. Well, thank you to everybody who voted. I'll go ahead and close the poll. I'll go ahead and share the results. Here we are.
Shared IT resources. Yeah, that's kind of what we expected, but still a strong holdout of the IT dedicated.
Yeah.
Some use of the low code. Yeah.
Yeah, I think. I think that's follows. The feedback that I've gotten in the field anyway, that people are still fairly heavily reliant on IT to support their back office applications for the most part. But I think that need will diminish over time with some of the modern applications. So,
great.
Okay, I think we're getting to time here, Ian. So we had hoped to take some questions, from the field, but in the interest of time, I don't think we're going to be able to. But certainly feel free to submit any questions if you need further information. And Ian, if you could put up the thank you slide, I think we'll go right to that, given that it's the end of the hour. So this gives you contact information for both Aria and ourselves. I wanted to thank Michael and the Aria team for helping with this webinar, and thank all of you for attending. And we hope to talk to you in the future soon.
Thank you.
Yeah, thank you, Michael.
Yes. Thank you very much, everybody.
All right.
Thank you, Tom. Thank you, Michael. And thank you to our audience. Hope everyone has a great afternoon.